Welcome back to Barry Charles, your one-stop shop for everything finance, whether it's stocks, cryptocurrency, side hustles, businesses, you name it, we got it right here for you at Barry Charles. In this video, we're going to discuss AI, the AI robotics company Teradyne. Is this company worth looking at buying, or was it totally overvalued right here, right now? We're going to find out as we do a stock analysis on Teradyne, as we look at all the key metrics, including revenue, net profit loss, PE ratio, dividend, free cash flow, and so much more in this episode. And if you stay right to the end, I will give you the Graham calculator's intrinsic value, as well as my own personal intrinsic value of this company. Remember, all these videos are for entertainment and educational purposes only, not financial advice. But let's get to it. Stock analysis on Teradyne. Welcome, guys and gals, to the channel. We're going to look at Teradyne stock analysis. And first off, we're going to look at the revenue. Yes, the revenue is around $3 billion in 2022, and looks like it's going to go up a little bit. I mean, it's going to be a bit of it's going a downtrend in 2023, so that's not a good sign. Can they continue to grow? That's the biggest question that has been around at the moment for Teradyne. Are they going to be able to continue to grow? Because if we look at the net profit, we're looking at 715 million, which is which was down on the 1 billion in 2021. So this is another one that's a bit iffy. So what's happening with this company? It's going downwards, the profitability, instead of going up. This is something that the company is going to have to really work on to get this business continuing to grow and grow and grow. Earning per share is very good for this company of this size of 2.8, so that's very good. And the PE ratio is a bit higher, 35. For a company that, I don't know, it's super duper growing, so that's an interesting play on with that company. Looking at the dividends of Teradyne, it's not much of a different dividend, to be honest, at 44 cents with a dividend yield of 0.44. So really, that is not much worth talking about the dividend. It's not really giving you much value at all, to be honest. It's like a little bit of loose change. But the assets versus the liabilities, this is an outstanding one for Teradyne. This is why people are buying this stock. Well, not why, this is a reason why they're buying this stock. 3.3 billion in total assets. It has come down a little bit, so that's a little concerning, from 3.8 in 2021, so that's a little concerning. But the liabilities have been very impressive, down to 960 million from 1.24 billion from 2 years ago. So that is exciting news for you, and that's a very big, great ratio. Absolute asset versus total liabilities ratio, that is brilliant. So this is what reason they're in the stock, but even more importantly is here. This is the free cash flow, 103 million right here, right now, but it's been up and down. It has been to negatives 500 million. So this is a very much a bit of that was in 2021. It's really all over the show a little bit, so not great that it hasn't been solid. So that's the concern. But 103 million right now, they can pay all its long-term debt of 32.8 million right here, right now. And should they? It's up to you whether they are looking at acquisitions or think they can spend their money more wisely. To me, I'd be paying off their long-term debt, take it out while the interest rates are so high, get rid of it, boom, thank you very much, and move forward. That's the way I'd be doing. I'll be looking to do that, because the next metric they've been doing beautifully. Shares outstanding from 194 million in 2018 down to 154 million currently. They are absolutely giving more money back to you as the shareholder. This has been a sweet thing, and that's why I think this stock has been at a premium for a while, because of that, the assets there and the free cash flow at times. So they do have a good revenue to net profit rate as well, if they can improve that. But this is why people are investing in this company, and they do expecting growth. But I think the big thing with this company at the moment is obviously all the AI talk around the stock is probably up a bit higher than maybe it should be on current metrics. The collaborative robots has been the big talking point for this company, that this is going to be the game changer for them. I'm not 100% sure on that. Full disclosure, I used to own Teradyne, but then I sold out. Obviously I would have had more money in it now, but I've taken better opportunities along the way, so I'm not concerned about getting out of Teradyne at the time. But this is an interesting company to see how this stock goes, because when we look at this the intrinsic value, it's not good at all. Not good at all. Let's have a look at it right here, right now. The Graham's calculator intrinsic value, which we look at the share price with the earnings per share, the growth rate, and the current bond yield. Let's have a look. So at $99, we're going to say the share price is around $99 for Teradyne. At 2.8 earnings per share, with a 5% growth rate with the current bond yield, the intrinsic value of this company is around $54. Now, when you add a dividend, normally it's a little bit lower than that because they're already paying you out there, so it makes it a little bit less valued. If we jump that up to 10% growth with the same metrics, you're still overvalued at $83 a share. The only positive for the earnings per share, if the earnings per share went up to 4 and you stayed at the 10% growth, then you're starting to get to 118, so you're getting a little bit of value from the $99 stock right now. So so you want the even bigger than the earnings per share to go up more to get it more and more up. So what does this mean for a stock for potential buy? To me, it's just too overvalued. Unless you can see something in the books. Obviously, positives for this company is that the revenue and net profit, they're getting a lot from the top to the bottom line, so that's very good. They can easily pay their dividend, that's fine. The assets to total liabilities is brilliant. The free cash flow, if they can continue to improve that, then yes, the stock is very good. If they pay off some of their long-term debt, would help. And shares outstanding if they continue to do that. So there's a lot of positives with this company as well. But to me, they're just a little bit rich. But it seems to be the way. When the companies are doing pretty well, they seem to get overvalued. Where companies are not doing so well, get to be very undervalued and take a while for them to jump back up to where they should be. It just seems to be the stock market in general. But at the end of the day, as a lot of people say, it's the weighing machine. So in the short term, news can get you there, but at the end of the day, the profits that come up and they will lift your stock higher and higher if you continue to do profits. But if you don't, then you drop down the hill and continue to go down the hill. So those companies that are seeming undervalued but continuously growing their business, building their business, and eventually will catch up in the stock price. So don't you worry about whatever stock you're in if you think it's undervalued or overvalued, depending. Sometimes it's overvalued, maybe it's a good time to sell out and move on to the next one. But in terms of Teradyne, for me, it's too overvalued. Not even in my. And if I'm going to give it an intrinsic value right here, right now, in terms of where the growth rates are, I still think right now you're looking at a $60 stock here. Thank you for joining me here, Barry Charles. Have a great day out there.